Hi everybody and welcome to the Macro Compass Bond Market course. The bond market is a large and systemically important market for macro investors, and yet it scares away plenty of people. It's full of jargon, full of technicalities, and this is the reason why in this course we're going to try to break it down, make it jargon-free, and really make sure that we can all master the bond market together. And we're going to start doing that through our first lesson using a twofold approach to really understand and master the bond market. So let's go into it. So guys, the first approach to really understand bond markets is the macro approach. And the macro approach has a look at bond yields through the lenses of growth expectations, inflation expectations, and term premium. When we look at growth expectations, it's really important to make a distinction between cyclical growth and structural growth. What matters the most for long-dated bond yields is structural growth. And the ability of an economy to generate potential structural growth is mainly driven by two factors: demographics and productivity. When it comes to the long end of the bond market, it's really structural growth that matters the most. Cyclical growth instead is more important for the short end of the bond market. There will be cycles in which economic growth is above or below potential structural growth, and that is driven by the fiscal stance, whether it's stimulative or it's restrictive, by whether credit availability for the private sector is very abundant or it's very tight, by whether the earnings cycle and the labor market are growing healthily or not. Structural growth is really the driver behind the growth expectation for the long end of the bond curve. Cyclical growth, instead, is a bit more important when it comes to the short end of the bond market because the economic cycle matters more for the short end than it matters for the long end. But when you look at growth expectations embedded into bond yields, you're mostly referring to structural growth, whose components are mostly demographics and productivity, which we are going to cover in a second. The second part of this equation, which is the first approach to our bond yield understanding, is inflation expectations. When I talk about inflation expectations, I don't talk about today's CPI or today's inflation. I'm looking at long-term expectations about inflation. A bit similar to the story for cyclical growth and structural growth, what matters for long-dated bond yields is not today's inflation, but its long-term expectations about inflation. For the very short end of the bond market, of course, today's inflation matters more. That's true because the short end of the bond market is much more influenced by central bank decision-making than it is by other forces. But when you look at bond yields for the long term, long-end bond yields, it's all about structural growth and long-term expectations about inflation. The third component is the term premium. When we look at the term premium, one easy way to determine what that is, it's the compensation that investors demand to take on interest rate risk rather than just choosing to own and roll T-bills. So if you're an investor and you're looking to buy fixed income instruments, you can either buy T-bills or you can buy long-dated bonds. If you buy T-bills, let's say you roll them over for the next 10 years, that's one way to get fixed income exposure. Another way is to buy 10-year bonds today, and therefore locking in yields for the next 10 years. Now that requires you to take interest rate risk. And if the uncertainty about growth expectations and inflation expectation over the next 10 years is pretty wide, you are going to require a larger term premium, a larger compensation to take on that interest rate risk today rather than just owning and rolling 3-month T-bills for the next 10 years. The lower the uncertainty, the easier and more predictable the path around growth and inflation over the next 10 years, the lower the term premium, the lower the uncertainty, and therefore the lower the compensation you are going to require. Let's now have a deeper look into the drivers behind structural growth. And as we discussed, the first driver is demographics. And here you can see on the chart on the left highlighting a very important metric that helps us understanding how demographics developed over the last few decades. Working age population as a percentage of total is a very important metric to follow. And here in this chart, we can look that there are many European jurisdictions, France, Italy, Germany, Britain, but also Japan and the United States, and all of them had a very positive demographics trend between the 60s and the early 90s. That's because there was a demographics boom post-Second World War that actually helped the labor force to expand in all these jurisdictions. So the percentage of the total population that was working, that was actively contributing to economic growth, was expanding. That helps the prospect of any economy for structural growth. Now look at what happened from the 90s onwards. From the 90s onwards, we had the exact opposite trend. Working age population as a percentage of total peaked in many jurisdictions and started inexorably declining ever since. Japan led the way for all other jurisdictions with an aging population and really bad fertility rates, but all other jurisdictions have followed Japan on this bad demographics trend for the last 20 years. And if you look at the World Bank projection for the next 30 years, the situation doesn't seem to improve. What that means is, as economies are having a lower percentage of the population which is actively working, their ability to generate structural growth, which we saw here, being driven by demographics, is actually lower. So the first equation here that determines the level of bond yields, growth expectations, the first driver of it, demographics, was really not helping bond yields to remain high over the last 30 years. It was actually dragging them lower. What about productivity? Because productivity is the second driver of structural growth, which, remember, is one of the drivers of growth expectations. That is the first item in our equation behind bond yields. Productivity growth between the 90s, 2000 and 2010 in the United States, total factor productivity growth in green here was relatively flat. It averaged about 1% for the last 3 decades. So it didn't really increase anymore, and actually the trend over the last few decades has been declining. So the second main component behind structural growth, productivity, wasn't able to offset the decline in working age population, the bad trend in demographics, in other words. So combining the two, effectively over the last 30 years, you have had growth expectations, structural growth expectations, trending down pretty aggressively. That was one of the reasons why bond yields, long-dated bond yields, were declining pretty much relentlessly over the last 30 years. But now remember, in our macro approach, the second element we have is inflation expectations. And the chart on the left here shows the University of Michigan survey of 5 to 10 year ahead inflation expectation. That's the blue line. And as you can see, these inflation expectations were very, very elevated in the 80s, about 8%. They remained around 4 to 5% basically also in the late 80s, and it's only from the 90s onwards that the trend was pretty much declining and stabilizing around 2.5 to 3% long-dated inflation expectation. So the trend over the last 30 years, as per structural growth, has also been pretty much declining. Core inflation, which is the series in orange, basically followed around the same path. So not only inflation expectations were declining, but also actual inflation was consistent with this trend. In other words, the second main driver of long-dated bond yields, which is inflation expectation, was also relentlessly declining. One of the reasons why that was the case, and not only inflation expectation kept declining, but the trend was validated by actual inflation, printing lower and lower, and as you can see over the last 2 decades, barely averaging even 2%. One of the main drivers, but there are many that we can cover, was the big and rapid increase in Chinese working age population between the 70s and the 90s and 2000s. So look, why is this disinflationary? Well, the rapid increase in the Chinese working age population in the 90s behind around 400 million people up until almost 1 billion people in 2020, so more than doubling the working age population, effectively meant a cheap supply of labor for the West. China had a lot more workers, and we decided to offshore manufacturing and production more aggressively in China so that labor costs could go down, and that acted as a very strong disinflationary drag for Western economies. Not only that, but we had, of course, online sales, digitalization, technology that helped push down labor cost. Think about the statistics. In the 1980s, for a US company to generate the equivalent of 1 million sales today, you needed about 7 to 8 times the number of employees you need today. So relying less on labor, more on capital, more on digitalization, more on technology was a strong disinflationary force, but the increase in the Chinese working age population was also one of the reasons behind the decline in long-term inflation expectation, and also actually inflation remaining pretty low. This is a long-term macro discussion, but you can see that the United Nations projections for Chinese working age population over the next 20 to 30 years are actually on the other way around. So China is going to have a shrinking working age population, so the supply of cheap labor to economies will not be nearly as fast and disinflationary as a global force as it was for the last 30 years. But going back to our macro approach, structural growth and inflation expectation over the last 30 years also declined pretty aggressively. Now, one of the things you need to understand about the drivers behind long-dated bond yields is that growth expectation and inflation expectation matter a lot. Term premium matters a lot too, and we're going to spend some words on it in a second. But think about politicians and society watching structural growth and structural inflation relentlessly declining for 20 years, 30 years. What happens? Well, if your economy isn't really able to generate politically and socially acceptable levels of nominal GDP growth, you have to find a way to boost cyclical growth. So effectively, you're looking at ways to overlaying cyclical growth on top of very poor trends for structural growth and inflation expectations. Remember, how do you do that? Mostly through fiscal stimulus and the availability of cheap and abundant credit. And that is exactly what we did. So the chart here on the left shows US private and public debt as a percentage of GDP. And notice this is inverted. So if the scale goes down, it means the US economy is becoming more leveraged. This is exactly what we did. From the 1990s, when we were at total economy debt to GDP levels in the US at about 180%, we went all the way to almost 300% right after the pandemic. There was a rapid increase in total economic leverage in the US. Some jurisdictions around the world chose to use mostly public debt as a source of leverage, so think of Italy or Japan. Other jurisdictions didn't use the public balance sheet, so it seems they're more virtuous, but the reality is that they used the private balance sheet. So if I look at countries like Canada or the Netherlands or New Zealand or Australia or Korea or Norway or China, all these virtuous countries, when it comes to public debt, they have a mountain of private leverage, of private sector debt. So if you look at total economic leverage amongst all jurisdictions, basically developed market jurisdictions, you will find the same trend. We levered up our economies to make sure we could replace dwindling nominal growth with some sort of cyclical growth through fiscal deficits and through abundant and cheap credit. Why am I mentioning this in the context of the approach number one, which is the macro approach to long-dated bond yields, is that more debt over time equals lower yields. The chart here shows 10-year treasury yields over the last 30 years, effectively mimicking the trend of total debt to GDP in the US. And this makes sense because the more you're levering up an economy, both through the private sector and the public sector, The more debt, the more credit you want to create in an economy, the cheaper and cheaper interest rates must be in order to facilitate the process. And that's exactly what we are seeing. So in other words, the equilibrium interest rates for a very leveraged economy are obviously lower, because if you want to keep a very leveraged system afloat, you need lower and lower interest rates. This was also one of the drivers behind a lower and lower term premium. The predictability around the future path for growth expectation, inflation expectations, and therefore interest rates was very high. It was very predictable. The model was levering up an economy to try and offset structural declines in growth expectations, structural disinflationary forces. And the more leverage we threw to the economy, the more likely it was that interest rates had to be low. So the predictability around this trend was lower and lower, and so also term premium, also the compensation that investors required to take on interest rate risk was not as much, because it was very predictable where we were going to go, lower and lower bond yields. So let's recap what we learned until today, until now. The first approach to master and understand bond yields is the macro approach. And the macro approach looks at bond yields through the lenses of growth expectation, inflation expectation, and the term premium. When it comes to growth expectations over the last 30 years, poor demographics and stagnant productivity were acting as a drag for structural growth. They were helping, in other words, pushing down bond yields pretty much in a never-ending, never-stopping trend for the last 30 years. Term premium was also compressed, because what we ended up doing is to offset dwindling structural growth. We levered up our economies, either through the private sector balance sheet or through public debt, to try and create some cyclical growth impetus to offset bad demographics and stagnant productivity. The problem was that the more we leveraged the economies through the creation of mostly unproductive debt in the long term, the lower and lower bond yields had to be for the entire system to keep afloat. In other words, when it comes to term premium, when it comes to the uncertainty around the future path for interest rates, the uncertainty wasn't very high. Structural drivers of growth and inflation were trending down, and the leverage, the unproductive leverage we were adding to the economy, kept pushing bond yields lower and lower. This approach helps explaining overall why bond yields were in a declining trend for the last 30 years. And notice the macro approach that I discussed so far for the long end of the bond curve does not talk about quantitative easing and central banks. The bond market is not all about QE and central banks, but the first approach, our macro approach, looking through the lenses of growth expectations, inflation expectation, credit leverage, and term premium, is a very useful framework to understand bond yields over the long term. So, the first approach, the macro approach, is very helpful in many cases, but we need a complementary approach, a technical approach to bond markets to understand really how bond yield works and what are they driven from. And look, one way to look at this is the 40s. In the 40s, one of the main drivers of our macro approach, consumer price inflation, and therefore also inflation expectations, were rising rapidly, all the way to 10% or 15 to 20%. So those are very, very elevated levels of inflation, and also inflation expectations were rising back then. Despite, though, having one of the main drivers of our macro approach pushing towards higher and higher interest rates, higher and higher yields, as you can see in the chart, real interest rates in red were actually as negative as minus 10% and minus 15%. In other words, nominal interest rates were stuck to zero, despite one of the main drivers of our macro approach, inflation expectations, pointing higher. And why? Central bank dominance, yield curve control. The Federal Reserve was effectively pinning yields, long-dated yields, nominal yields at 0%. Despite macro fundamentals pointing to something else. That forces us to think of a complementary approach to understand bond yields and the drivers behind bond yields. And one of the easiest way to do that is to think about cash flows. So this is a very common and easy formula to understand, which is the price of a bond. And the price of a bond can be thought of as the present value of all future cash flows. So look, these are the coupons that the bond pays, and these are the discounting factors. So we're basically taking all the future coupons that come out of our bond, and we are discounting them to time zero. So in this case, bond prices really didn't go anywhere, because even if the macro drivers were pointing towards higher inflation expectation, therefore higher yields, the reality is that as the Federal Reserve was effectively pinning the level of interest rates, there was no way for yields to reflect macro reality, but rather you should just have looked at future coupons and future discounting values. But now, instead of thinking of coupons, through the introduction of swaps in our technical approach, we can also think of 10-year interest rates as a strip of all future Fed funds rates, overnight rates for the next 10 years, discounted back to today. So the 10-year yield that you see on the screen every day, you can think of that as nothing else than the Fed funds overnight that will be prevailing every day for the next 10 years, discounted back to today. So you can think of bond yields in two ways, through their macro drivers and through a cash flow approach, a discounting approach, a technical approach. The combination of the two is very powerful. First, let's understand why you can think of 10-year interest rates as a strip of all future overnight interest rates for the next 10 years, discounted to today. Let's introduce the concept of swaps. So what are swaps? Swaps are nothing else than an agreement between two counterparties to exchange a set of fixed cash flows depending on a fixed interest rate with a set of floating cash flows depending on variable future interest rates. Now, if you look at the formula to calculate the present value of a swap, what you really have here is a set of fixed coupons depending on a fixed rate, are fixed, all discounted, this is the discount factor, all discounted to time zero. You have this leg, the fixed leg, the set of fixed cash flows, the present value of all future cash flows determined with a fixed interest rate. And you have also on the other side, the present value of all cash flows determined through what the variable rate, the floating rate, will be over time. Also, these, of course, are discounted to time zero. Now, the way that you price swaps in market is that you're looking for a present value of zero. So the difference between the two legs effectively needs to be zero. Why is this important? Because in other words, by setting the difference between the two legs being at zero, what you are doing is you are having a, let's say, a 10-year fixed interest rate here that you determined to find the fixed cash flows of the swap being nothing else than the equivalent of all the future overnight floating rate for the next 10 years discounted back to time zero. So in other words, you are solving and you're pricing all swaps in the market, having a 5-year or a 10-year or a 30-year fixed rate that you watch on the screen every day, the 5-year treasury yield, the 10-year treasury yield, those fixed interest rates you watch on the screen are determined to be equivalent to all future floating rates, overnight Fed funds rates, variable overnight interest rates discounted back to time zero. And that's why you can think of 10-year treasury yields, the 10-year fixed rates you watch on the screen, as a strip of all the future overnight variable interest rates for the next 10 years discounted back to today. This is a very, very important concept to understand because the combination of macro approach, of the first approach, and the technical approach will be a very powerful combination to understand bond yields. Now let's have a look at the visuals as well to really cement this understanding of how to think technically about bond yields. So let's try to simply visualize the pricing of a 5-year overnight index swap. So we are pricing a 5-year swap where the counterparty yellow here pays the 5-year fixed interest rate. As we record on the 14th of July, that's 3.7875%. And he receives floating rate instead. Orange, the counterparty of the swap, pays the floating rate overnight for 5 years, and he receives 3.7875 fixed. So it's an agreement between the counterparty orange and the counterparty yellow to exchange a set of fixed cash flows for a set of floating cash flows. Now, let's have a look at actually how these cash flows are built. Remember, the cash flows are built so that the present value, the difference between the present value of these two legs is 0. And if you look at the current market pricing for overnight Fed funds over the next 5 years, so this is the floating rate determinant, the orange line, this is what the market is pricing today. The market is pricing Fed funds at about 5%, in early 2024, and then slowly but surely declining all the way down to 3%. So if I look at the cash flows here, what I can see is that in 2024 and in early 2025, the counterparty orange, which pays the floating interest rates, it pays the today's Fed funds, in other words, in 2024, will be losing money because he receives the 3.7875 fix by the other counterparty, but he pays a floating rate which is higher, so he will be losing money. As we go into 2025, 2026, and then later, 2027, 2028, Orange will be making money instead. He will be making money because he receives a fixed rate of 3.7875, and the Fed is priced to cut interest rates below that level. So he will be receiving a higher set of cash flows, fixed cash flows, than the floating rates that is set to pay, at least according to what the market is pricing today. If you sum all these cash flows together, you get 0. That's, remember, the present value of the future cash flows paid by the orange and paid by yellow. So in other words, the 3.7875 fixed 5-year interest rate. So let's say the 5-year treasury yield that you're watching today on the screen is really nothing else than the sum of all the future floating rate, Fed funds rate in 2025, in 26, in 27, in 28. The sum of all the future interest rates discounted back to today. Those two, the orange floating variable Fed funds rate discounted to today, and the yellow, the fixed 5-year yield that you watch on the screen every day, are the same thing. This is why you can think of 5-year interest rates as a strip of all future overnight interest rates for the next 5 years discounted to today. And so if you walk back to the 40s, and if you were relying only on the macro approach and you said, yeah, okay, so it's a macro approach, I need to look at growth expectation, inflation expectations, and term premium. Well, inflation expectations were in double digits area. Term premium should have gone up because there was a lot of uncertainty about what inflation would have been in the future and growth would have been in the future. But this approach only, that would have suggested much higher bond yields, wasn't really helpful back in the 40s because the Federal Reserve to central bank dominance was effectively pinning the level of Fed funds to 0 for a prolonged period of time. So using instead our approach here, you could think of 10-year Fed funds back in the 40s as a strip of all future Fed funds for the next 10 years. And as the Fed was basically determined to keep Fed funds at 0 for the next 10 years, you could make sense of nominal yields at 0, despite macro fundamentals pointing to potential levels of nominal yields being much higher. That's why it's important to combine both approach, the macro approach and the technical approach, which helps you think of 5, 10, and 30-year interest rates as a strip of all future Fed funds rates for the next 5 years, next 10 years, the next 30 years, discounted to today. So at this point, let's recap what we learned today. In the first lesson of this bond market course, we learned how to look at a twofold approach to understand bond yields. We have a macro approach and we have a more technical approach. The macro approach looks at long-dated bond yields through the lenses of growth expectations, inflation expectations, and term premium. So you can think of long-dated bond yields as being impacted by demographics and productivity, the drivers behind structural growth, inflation expectations for the long term, and term premium, which is a measure of compensation that investors demand to buy long-dated yields rather than just rolling their T-bills every 3 months. So it's a measure of compensation they require to take on interest rate risk today against the uncertainty or future uncertainty around the drivers of bond yields. This is one very important way, the macro approach, to look at bond yields. The macro approach, though, isn't all the time enough, especially in certain situations where central bank dominance comes into play. For example, as we shown in the 1940s, despite inflation expectation, one of the drivers behind the macro approach for bond yields, despite inflation expectations pointing to the upside very materially, nominal yields were basically pinned to zero for the entire decade. The macro approach alone wouldn't have worked. That's why we introduced the technical approach. The technical approach looks at bond yields in a different way. You can think of 10-year bond yields as a strip of all future Fed funds for the next 10 years discounted to today. And combining these two approaches together really helps you making sense of the bond yields you watch on the screens every day. 5-year, 10-year, 30-year bond yields that you watch on the screen every day can be made sense of through the combination of the macro approach and the technical approach. Especially for long-dated bond yields, you can think of the macro approach, growth expectations, both structural and cyclical, inflation expectation and term premium, but at the same time also taking into account the central bank stance through thinking of 10-year bond yields as a strip of all future Fed funds for the next 10 years, discounted back to today. Now, combining these two approaches will be one of the key ways we will study and understand several angles of the bond market. We will start from a deep dive of the short end of the bond market, move to the long end, talk about the yield curve, the different regimes and why they're important for other asset classes as well, and the macro understanding of markets. We'll talk about real yields, inflation expectation more in details. We will talk about credit spreads and the credit markets. In other words, we will use this twofold approach, combine it with several other approaches to really dig deep and break down all angles of the bond market. So come and join us through this macro learning journey.